All right, this is Kerry Artak with Artak Advisory, and this is the video supplement for the AgriTalk PM show for Monday, April 26th. In Monday's show, I cover three markets, July corn, August ethanol, and June live cattle. Before I jump into the charts, just want to emphasize the fact that I do offer a 2-week, no questions asked free trial. You just fill out the free trial form on the website itself. It's posted all over the place. First name, last name, email address, of course, and a phone number. I'll call you during the 2 weeks to talk to you about your trading or hedging needs, answer any questions you might have. Ideally, the prospect would be that you become a regular monthly subscriber, but there's no obligation. I don't ask for credit card information. It's pretty easy, straightforward, and if you haven't had a free trial in the last 6 months, I do offer a 2-week free trial every 6 months, so there's that as well. So yeah, jump on that free trial if you would. Would love to hear from you and talk to you. Anyway, here we go with July corn. Big rally last week. This is a weekly continuation chart. By the way, all the charts I'm showing you are weekly, with the exception of ethanol. I show monthly continuation charts because it's more of a big picture trade that we've been in the midst of now since January. But let's talk Chicago Board of Trade corn. This is July contract, the weekly continuation chart. This is based on volume rollover. In other words, July inherited this chart a couple of weeks ago when May volume dropped below July volume levels. At the time, I can backtrack a little bit. Let's talk big picture, actually. I'll backtrack a lot. 465 is the new floor of long-term support, as I keep saying on the show. We did settle above this formation in late December. At that point, I was mentioning that the 640s are the big picture objective, and we're close to realizing that. We will probably test that level this week. We had a limit up move, obviously, last Friday. Now, along the way, 579, 50% retracement. I'm calling this AB. I don't have that labeled, unfortunately, but A is nothing more than the 2012 high of 849, and B is nothing more than the 2020 low of 309. So halfway back up was 579. We did top out there when the March contract was front and center in early February, and we spent a fair amount of time there for a couple of weeks, topping out for several days on end when May was front and center, and then during the rollover, we continued to push higher. We got the buy signal a couple of weeks ago above 579 even. On the show, I mentioned that having closed above 579 even, we should now reach this 644 3/4 target within a matter of 1 to 2 months. It's looking more like 2 to 3 weeks at this point in time. 644 3/4, long-term descending 2/3 speed line projected off the 2012 high. This is a trend-defining line study. I can't get deep in the weeds on how they're constructed, but just take my word for it, if you will, that they are a significant a trend-defining element. And also what I like about it at this point in time is it's converging with the 5/8 Fibonacci retracement level. That's also AB, the 2012 high against the 2020 low. 5/8 back up is 642 3/4. So a lot going on in the low to mid 640s. This is an area that can contain annual buying pressures. From here we could back off to 579 even within a few weeks, and perhaps as far south as 465 by the end of the year, although I don't have an indication of that. I'm going to show you an intermediate support level in a moment, but before I leave this chart, I just want to mention that if we do close above 644 3/4 by a full 1% margin, and on the show I'll mention that number. I don't have it in front of me, but you can do the math. 6.4 plus 644 is going to be around 651 or so. 651 1/4, I believe, is the level that if we settle above, if we settle at 651 1/4 or higher on Friday in the July contract, we have a significant secondary buy signal that should play out into summer, and I would expect this market to maintain its vertical status, this 834 half level, then consider the next realistic 3 to 5 month objective if we close this week above 644 3/4 by that 1% margin. Until then, we can top out here, as I say, through the rest of the year. On the way down, 579 even offers decent support, but really, this is your trend-defining support right now, and it is based on last week's 636 half high. So if we push to new highs, these get recalibrated, just an FYI. But at this point in time, 530 half offers solid pullback support that, if tested, say between now and the end of June, can absorb selling through summer trade. Once we test it, we can rally back into the mid 640s again within a matter of several months. So there is a scenario that could unfold where we trade below 644 and 3/4 as a ceiling, we back off to 530 half as a floor, and we trade inside that zone all the way through summer. If we close below 530 half at the end of any week, then you guessed it, this 465 becomes our next 2 to 3 month downside target, where I would expect the broader corn market to bottom out through next year. Let's move on to ethanol, the corn-related energy. On the show back in January, I mentioned a buy signal that played out above this 1.476 formation. And by the way, this is the August contract reflected. That's the lead active contract right now. And having settled above 1.476 in January, I mentioned on the show that the 2.226 formation became the next target. We're likely to test that. I don't know about this week, but probably 2.226 can absorb buying really into summer trade, possibly the rest of the year. And from here, over the next 3 to 5 months, we could back off to 1.476. This is the lead ethanol contract, by the way. Presently reflects August. Whatever the high volume contract is will inherit these points. If, however, we do close above 2.226 at the end of this week, which is also the last trading day of April, I expect bullish continuation to the 2.429 area. And that's another channel top that actually goes back further in time, following the all-time high in July of 08 of 2.86. We dropped to this low area. So I'm just following the rotational sequences here. And this is probably a more meaningful resistance, actually, than the preceding 2.226 I showed you just a moment ago, because it includes a longer time horizon, more back data. So this is really our ceiling, I would say, through next year, perhaps. I don't anticipate it, but if we did close above 2.429 at the end of any week, then we have a retest of the mid 280 highs that we experienced, really a double top here, 08 and 14. That would be a retest, but not until we close above 2.429 at the end of any week. So to encapsulate, if you will, the ethanol market, 2.226, our ceiling really through the rest of the year. From here, we can fall back to 1.476 by the end of summer. If we take out 2.226 to the upside, then 2.429 becomes the next, I'm going to say, 3 to 5 week target, where once again we encounter a resistance area able to contain annual buying pressures. And finally, June live cattle. Last week was notable in that the June contract settled below a key support level on the weekly chart. This week at 117.45, this is a fresh sell signal. And so they often need another week to fully play out. In other words, another down week from here, and this is really confirmed. I mean, it's a confirmed sell signal anyway. It's just that there are times where the market can rally back, close back above 117.45 at the end of this week, and then it shakes out all the shorts, and we rally into the mid 120s within a few weeks. I'm going to show you that in a moment. But right now, I'm saying ceiling at 117.45, able to contain buying through summer, and below which there are some stair-step support levels on the way down, but honestly, I have a 3 to 5 month downside target now at 97.05, which by that point in time, 3 to 5 months from now, will be the August contract. All subsequent contracts will inherit these levels because this is a volume rollover weekly continuation chart. So I'll leave you with this chart here, 117.45, our ceiling. This is rising. This is one of the reasons why I encourage you to become a subscriber, actually, because you'll be made note of these levels through time. My approach is very dynamic. It's ever changing. These line studies change through time, and you need to know them. What was 117.45 this week, next week will be 118.17. That's just a for instance. So these levels do change, but 117.45, our ceiling through summer, below which the broader live cattle market should continue into the upper 90s over the next 3 to 5 months. On the other hand, if we close this week Friday back above 117.45, that is a failed longer-term sell signal, in essence a valid sign of near to mid-term strength. I would expect 124.25 in a hurry within about 2 to 3 weeks, where we could actually top out through the balance of June contract life. But if we happen to settle above this 124.25 formation, that's actually a reversal buy signal into later summer. The next several months then expected to continue on into the upper 130s, where we could top out through the balance of the year. But this upper scenario is not even relevant at this point in time. I'll leave you with this, as I said a moment ago, holding below 117.45. Broader live cattle remains bearish through summer, anticipating the upper 90s over the next 3 to 5 months. And that is all I've got for this week's AgriTalk video supplement.
So do yourself a favor. Fill out the free trial form on this website. Take that 2-week test drive. You have nothing to lose and much to gain.